And if you use that tool and you punch in your bank and you get the sort of the red flag or kind of the angry emoji, then you know that your bank is not climate aligned and that your deposits are directly getting turned into loans for fossil fuel companies. And there's really no need to do that.
This podcast has a couple of goals. It's to explain climate and energy topics that you probably never thought about but are incredibly important to your daily life, and to also give you actionable things that you can do to be a better environmental steward. We have a great topic and guest for you today, and at the end, we're going to answer this question. Is your checking account balance actually making the climate crisis worse? This is Plugging In. I'm Barry Wygel. Welcome to Plugging In, powering our way to a brighter and healthier New York. I'm your host, Barry Wygel. Each episode on this podcast, we will discuss a different topic related to clean energy, explaining complex topics in a way you can understand. Become part of the community as we help to make a brighter and healthier New York.
As the sun crests on the horizon, a new day dawns in our state. A new hope for tomorrow is rising, a clean future we create. Tomorrow we breathe easier, tomorrow the skies are clear. Today we are plugging in, the future of New York is here.
Our guest today is Tim Nash. Tim is the founder of the company Good Investing, which offers investment coaching. He also hosts a podcast of the same name, and he blogs as the Sustainable Economist. Tim, welcome to Plugging In.
Barry, thanks so much for having me.
So I think for most people, their investments, when they think of their investments, it's their company-sponsored 401k, similar program, something like that. So how do you even know where your money is and what company it's supporting?
Yeah, the first question is always, or the first step is always to start asking questions. So really you want to take a look at your statements, right? You want to ask questions. Typically, most people are invested in what are called funds. Mm-hmm. And so if you can get the fund name or the fund code, then there are some really, really nice websites and tools that we can use to be able to see what's actually inside. If you ask your sort of the provider, for a list of companies, sometimes you can get the full list of companies. Sometimes they'll only give you the top 10. So, for example, there's a nonprofit, there's a website called As You Sow. It's SOW, as in sort of sowing seeds. But As You Sow has a really cool tool where you can punch in the fund name or the symbol, and it'll give you scores when it comes to things like fossil fuels, when it comes to things like weapon involvement, all these different, there are a variety of ethical issues that people really care about, and that you'll be able to see if there is some nasty stuff inside of it. But the fact is, if you've never asked before, it's a pretty safe assumption that there are bad things inside your portfolio. That is sort of the default option for most of these investment plans.
And I think people would probably be surprised at what their money is supporting if they actually dove into it. I remember when I got my first job and they, said, do you want to contribute to this 401k? And I said, yep. And they said, when do you want to retire? And I said, 2050. And they said, okay, you're all set. So the people that listen to this podcast are climate-focused New Yorkers. So I think it's a receptive audience to asking those questions. These are the people that are interested in where their money is going, and they might, make choices on a day-to-day basis about what companies to support, what to buy, things like that. You might be unknowingly giving a large chunk of your money in investments to a company you don't like. So let's say you follow the advice you gave in the first question. You look up the fund that your money's in and you see a company that you don't agree with. What's the next step to divesting that money? Really
what you want to do is, again, start by asking questions. And it really comes down to this notion of how much control you've got over the choices. That if you're with a pension plan, like I hate to break it to you, but I don't think they're going to make a special, Barry portfolio, green portfolio just for you. Same thing with a lot of the sponsored plans that, there might be a sort of socially responsible option available to you. So certainly ask what the options are and see if there is something that aligns with your values. Sometimes it's just as simple as ticking a box saying, I would like the socially responsible option, and you'll get the same return but with a much cleaner portfolio. And then, for those of us who do have control, who do sort of manage it ourselves, or if it is your own personal money with an advisor, that's where you are the client, you are the customer here, and that you can choose and have a say in which types of funds that you own. So again, it's a very simple switch that now, there are all of these wonderful socially responsible products. That's sort of the old term. We've evolved from socially responsible investing to now a lot of folks are calling it sustainable investing. Under that banner, there are a whole bunch of different approaches. And you talk about divestment for people who say not one penny into fossil fuels, then really you're looking for a fund that has excluded fossil fuels is the language that we use in the industry. And typically these funds, certainly they are available widely in the market. So if you do manage the money yourself, or if you work with an advisor who has access to the entire market, then these are no problems. But really the first step is understanding, how much control do I have in these selections? And do I have access to that sort of full shelf of products that are available in the marketplace?
Very good point. So if you go on and you see that the fund that you're invested in has a company you don't agree with, you can't change what's in that fund, but you might have the option of changing funds. And then if you work with a financial advisor or it's an IRA, something like that, that's when you have the power.
No question. When it comes to our personal investments, we have much more agency and control. And then sort of, people who rely on, company sponsored things. And then certainly pensions is probably the least choice.
Right.
You can do advocacy work to sort of, write some letters and organize and try to push them in this direction, because a lot of them are. But obviously that's going to be a heavier lift than if you're doing it yourself. It's just a matter of simply, selling the fund that's got lots of things you don't want, and then replacing it with a fund that has the exact same risk profile, has almost identical returns, but does have a sort of socially responsible or sustainable label that adheres to your definition. Because I do want to be clear about this. There is a spectrum from sort of a small step in the right direction all the way through to what I call my crunchy granola type funds. And the further we go down that spectrum, we do start to see some trade-offs that start to emerge. You're less diversified. Sometimes the fees are a little bit higher. Really it depends. And so really it's about choosing the fund that is right for you. But in most cases, we can choose an almost identical fund that just simply has the exclusions that you're looking for.
So when you choose to be a more sustainable investor and you choose a fund that aligns with your values, are you sacrificing your retirement, your profit potential?
You really don't have to. And again, there are a wide range of choices here. The language that I use is differentiating between what I call doing less evil funds versus doing more good funds. Mm-hmm. And the doing less evil funds, these are the ones that use strategies like divestment, so these negative screens, these exclusions. They can use strategies like ESG, environmental social governance, which is data and integrating that data into the decision making. And they can use strategies like stewardship, which is, as a shareholder, you kind of have a voice in how that company operates. And so using your voice to push that company in a more sustainable direction. So these are all approaches that really don't sacrifice returns at all. Now, obviously, if you've divested from fossil fuels, right? If fossil fuels have a great year, if oil stocks have a great year, well, you don't have exposure to that. You will underperform slightly that year. That said, when fossil fuels have a terrible year, which they've had a few terrible years in the last decade, right? Then you're missing out on those. In that case, you'll actually outperform by a little bit. But really the goal with these doing less evil funds is to earn the same exact financial returns that you would otherwise, but doing it in a way that is more aligned with your values. When we get into the doing more good side of the equation, that's where the returns can deviate. If we look at things like clean energy funds, they did really, really well in 2020, had an incredible year, absolutely popped, but have performed quite poorly since then. Right? So depending on your timing, you might have made more money or then less money sort of since then. And then as well, there is this really cool area that I call impact investing. These are going to be, local, small scale. This is the really crunchy granola stuff. Community bonds. I know you've talked a bit on the podcast about community financing for renewable energy projects. So that's a really cool space. But obviously the goal there, we're not trying to maximize risk-adjusted returns. That for most investors, the goal there is to maximize impact. impact. And then, hey, whatever financial return we get is kind of icing on the cake. So, obviously with those funds, there might be a sacrifice in terms of that risk return profile. But really, I think most people, when we talk about sustainable investing, ethical investing, they do typically mean these sort of doing less evil funds. And I want to be clear, those have performed just as well as traditional funds, in some cases a little bit better.
And I think it's important to remember for people how much money we're talking about. And I think as you get older, hopefully your retirement portfolio is a significant chunk of your net worth. So it could be hundreds of thousands or more dollars. And you might make a choice to not spend $5 at a company that you don't agree with, or $100 at a company you don't agree with. But you could be doing, exponentially times things that you don't agree with in your retirement portfolio. So it's important to remember how much money you actually hopefully have for retirement saved up. Now, if you want to go about these steps that we've talked about, how much time are we talking about? Is this going to take hours a day watching CNBC and Bloomberg to figure it all out? Or what's the commitment people need to make?
No, really, once you've got it set up, it works exactly the same way that your existing investments are set up. And I really don't suggest people try to time the markets or watch, CNBC and try to, unless you want this to be a second job for you, but I think most of us have more important things to do in our lives. So we really want to take sort of a set it and forget it approach to this. And that really, the approach that I advocate for, we sometimes refer to it as a couch potato strategy, where we're essentially building a portfolio, we're building a pie chart, and then programming the system to be able to invest according to that pie chart. And that there are now some really great tools that are available that do all of the rebalancing automatically for you. So really, it's the upfront work of figuring out what your values are. Mm-hmm. What are the things that you want to divest from? Right? And then picking the funds that do align with your values. So there are some research tools to be able to find these funds, and then, putting together a portfolio. I do suggest people work with a professional. So whether you've got an advisor or there are these great fee-for-service financial planners that are sometimes referred to as fiduciaries, where you can actually pay them sometimes by the hour just to kind of take a look at things and make sure that you've done it right, that the pie chart that you've built is appropriate for your age and your risk tolerance. And then once you've got it set up, I'd say it takes maybe like in the ballpark of like 4 or 5 hours to do all the research, do all the decision making, plug everything in. And then once you've done it, it literally takes, minutes every month or quarter, depending on how aggressively you're saving. And in some cases with some of these automated systems, it really takes no time at all. You can just set it and forget it.
It's very interesting. I want to flag one other thing you said. You keep saying choosing funds, not choosing stocks. And that is an important distinction. So just do a little PSA on the difference between those two terms.
Please don't pick stocks. So when you pick stocks, you're choosing to invest in individual companies, and that a core value when it comes to investing is diversification. And in the same way that nature relies on diversification to build a resilient ecosystem, investors rely on diversification to build a resilient investment portfolio. So diversification is our best friend as investors. And so if you are going to pick individual stocks, then you're signing up for a side job, because your job is now to monitor those stocks, and because not only decide what to buy, but to decide when to buy and when to sell is the hardest part for owning these individual stocks. And there's really no sense doing that anymore. We have these low-cost funds. I'm a big fan of ETFs, exchange-traded funds. These are very, very low-cost, diversified funds. And then now as sustainable investors, what we're looking for are ETFs that have some sustainability screens to them. So we're looking for, again, negative exclusion. What are the things that they exclude and get rid of? And these are usually sectors. And then as well, hopefully they're doing this ESG integration where they are looking at environmental, social, and governance data when it comes to, what companies they're putting inside of these funds. And then the last thing is stewardship, is asking, hey, is the fund gets to vote, my shares for me. I'm giving them that permission. I want to make sure that the fund is actually voting it in a way that pushes these companies in the direction that I want to see them pushed into.
So another thing that people might not think of as investing, and I certainly didn't, is my checking and my savings account. So why should I be thinking of that as investing?
Ooh. So really, it's about understanding the impact of your deposits. So there's a fantastic organization, Project Drawdown. You might be familiar with them, but they do a lot of work in terms of sort of solutions and impacts around climate change. And they did a study showing that having, I think it was about $8,000 in a checking or savings account has as much of a carbon footprint as flying from the East Coast to the West Coast and back, like a return trip. Back and forth.
Wow.
And so, it's one of these things where the way it works is that in our banking system, we use something called a fractional reserve banking system, such that our deposits, banks take those deposits and they actually leverage them. There's a multiplier effect, and they loan that money out. Who do banks loan money to? Well, probably some mortgages and some small business loans, but especially the bigger banks loan that money to the big corporations that probably aren't aligned with your values. So there's this amazing tool that I use, bank.green is the URL, and this allows you to look up your bank or credit union to see what the carbon impact, how good are their policies. And if you use that tool and you punch in your bank and you get the sort of the red flag or kind of the angry emoji, then you know that your bank is not climate aligned and that your deposits are directly getting turned into loans for fossil fuel companies. And there's really no need to do that. There are all these amazing banks and credit unions. Some of them are B Corps. I don't know if your audience will know about B Corps, but this is sort of a stamp for companies with a better social and environmental policy. And this wonderful site, bank.green, lets you sort of shop around for a checking account and savings account that actually is low carbon. And again, this is a very simple action. When you talk about your spending and having to choose, every single time you go shopping, or some of these green choices we make are really hard with a lot of trade-offs. This one's easy. Like this one is just simply you do it one time, you switch your checking or savings account, you switch your investments, it's kind of a one-time deal, and then once it's done, you're having those sort of that low carbon impact every year for the rest of your life.
Okay. I have my homework too. I got to look up my bank on there. I wasn't familiar with that. And you're not sacrificing, like you said, your FDIC insurance or anything like that. So
no, they're all going to be insured. Some of them have different interest rates. So you always want to, shop around for the right financial situation for you, but they all have the apps, they all have ATM networks, and, it really is the exact same experience. In fact, some of them actually have lower fees or better customer service. Most of us have never shopped around for a bank account. We just kind of have the one that our parents got us when we were a kid. Or, if you're an immigrant, you kind of do eeny, meeny, miny, mo and just kind of pick one at random. So, just take a few minutes, shop around, look at it on bank.green, look up their features, look at what the interest rates that they provide, especially for a savings account. You do want something that's financially competitive, but it's actually a really good opportunity. I find a lot of folks actually lower their fees or increase their interest rates because they've just been shopping around. They never really looked at it before. And then at the same time are lowering their carbon footprint.
Okay, definitely going to do that this afternoon. So perfect. So if people are interested in sustainable investing, they want to learn more from you and what you offer, how can people follow you or get in touch?
Yeah, so, I'm on a lot of the major platforms. My name's Tim Nash. My company website is goodinvesting.com. So I give free consultations. Anyone that wants to chat about their money and do that, you can just sort of fill out a little form there and we'll be in touch. And then I also have a classroom. So people that can't afford to hire me on an hourly basis, no problem. I've got a classroom that you can join that's got some resources on, how to fire your bank, how to set up an ethical emergency fund, and then also how to start investing in a way that's aligned with your values.
All right, Tim, I appreciate your time. Thank you so much.
Barry, thank you so much for having me. Big fan of the show.
Thank you for listening to this episode of Plugging In. I hope you learned something, and I hope you share this knowledge with someone else. It would be incredibly helpful if you leave us a 5-star review wherever you found this podcast. If there's a topic you would like us to cover in the future, or have a question about clean energy, send us an email at podcast@aceny.org. You can follow us on social media using the links in the show notes, or consider joining our Clean Energy Supporters mailing list at aceny.org/support. Your support is crucial to creating a brighter and healthier New York. I'll see you next time.
As the sun crests on the horizon, a new day dawns in our state. A new hope for tomorrow is rising, a clean future we create. Tomorrow we breathe easier. Tomorrow the skies are clear. Today we are plugging in.